take about a half hour. And what I would find is after about 15 minutes, even the most enthusiastic students, their eyes would start to glaze over, and I would kind of lose them. And that was painful for the students, and it was painful for me. I hate to see that. Okay? So if you want to work through the derivation of the CAPM, I invite you to do something. We're not going to do it in class. I'm not going to tell you. Okay? Okay, now remember what we said. Yeah.
That means you don't need to like even know the comprehension stuff? We don't need to know like any of these slides?
Oh, yes. Okay, now, you see this green star? The material of the slides for the star will not be covered on the exam.
Star in the front one, so.
The material on the slides.
Everything else we love is awesome. That analysis we did the last few classes is called the Markowitz Portfolio Selection Model. Harry Markowitz, Nobel Prize in Economics. Okay? And as we mentioned last time, it does not provide guidance with respect to the risk-return relationship with individual assets. And that's what the capital assets model does. Now, before we finish this set of material, I'm going to explain to you how the CAPM, in many important respects, fails as a model of risk and return. Okay? Give you some context of why that might be the case. I think it's important to understand the assumptions that are necessary to derive the CAPM. Because the model is mathematically correct. Okay? So if the model fails, it's because of the assumptions. Some of the assumptions were too strong. Okay? First assumption, investors are price takers and act as if security prices are unaffected by their own trades. It's true for you and me, it's not true for big institutions. Okay? All investors have the same identical single period planning horizon. Not true. We have different planning horizons based on our age, based on our level of wealth, most likely. Making the CAPM richer to account for this makes it an extraordinarily complex model. Three may be the biggest problem. Investments are limited to publicly traded financial assets and to risk-free borrowing and lending. Okay. Give me an example of an important component of wealth that's not publicly traded. Okay, real estate, for many investors, the most significant asset that you will acquire, at least for the first 10 to 15 years of your investing horizon, will be a home. Now remember, the amount of equity you have in your home may initially be quite small. Okay? If you buy a $200,000 house, you put 20% down, your initial equity, okay, it's not that big, it's $40,000. Okay? But, and hopefully through time, other forms of wealth will become more important. But it is true that your home is not a publicly traded asset, it's illiquid, and the fact that a lot of your wealth is concentrated in your home can affect the way you view other assets. Okay? But even more important than that, by far, your wealth resides in the value of your human capital, in the value of your knowledge, in your skill set. That's where your wealth is. So the question is, would the correlation of the value of your human capital with these macroeconomic risk factors that affect market performance, would that correlation possibly affect the way you invest? And the answer is yeah, of course it might. If your human capital is very risky, in the sense that when the economy goes into a recession, you're likely to lose your job, that's going to dramatically affect the way you look at the risk profile of individual securities. Okay? So this is a potentially big problem with the capital asset pricing model, that it ignores the major component of wealth, and that's the value of the human capital. Investors pay no taxes and no transaction costs. That's actually a problem. And we can build a model like the CAPM that accounts for different tax clientele but it becomes extraordinarily complicated, okay? If a model's not parsimonious, if it's not doesn't give a fairly simple set of relationships, you begin to question how useful that model is, okay? It's like a roadmap, okay? How much detail do you want in your roadmap? A roadmap has to be easy to look at and help you get from point A to point B. Okay? All investors are rational, mean variance optimizers. Okay? That's a potential problem with the CAPM. Okay? We know that everyone is not a rational, mean variance optimizer. Okay? We know that many investors are not rational. We know that investors are subject to making emotional investment decisions as opposed to logical investment decisions. Okay? One of the important ways in which markets can vary from efficient levels is a topic we're going to talk about tomorrow. We're actually going to introduce that topic through a game that we're going to play in class. Okay? This is a game that we're going to play for money. Okay? So if you'd like to participate and play in this game for money, the buy-in to this game is $1. So you have to bring a $1 bill. Okay? I'll also throw $1 into the pot, so it's more than a fair game. Okay? And you don't have to participate. If for any reason you find this objectionable, you can just observe. But I think it's a lot of fun. And the person that wins will walk away. If everyone shows up, you'll walk away with enough money to treat yourself to a nice, you and your significant other to a nice dinner out. Okay? So bring $1, okay? And don't bring $50. Don't sleep in, because I think this will be fun. It'll be informative too, because it will teach us about something about markets that's really important. And finally, the assumption is that there's symmetric information and identical information. This is obviously not true. We don't have billions of shares trading hands every day because everyone knows and believes the same thing. Okay? And the fact that some people may have better information than others can affect the way markets work. So the assumptions are pretty strong. Okay? Now, if we make those assumptions, we can derive a set of results which together comprise the capital asset pricing model. The first is that all investors choose to hold a portfolio of risky assets in proportions that duplicate representation of assets in the market portfolio, which includes all traded assets. All that means is that everyone holds a value-weighted portfolio of all traded assets. Okay? Second, the market portfolio, which consists of all of these assets, is the tangency portfolio in that analysis we did last time, where we trace out the investment opportunity set, and we find the optimal capital allocation line, and we find that optimal portfolio, that optimal risky portfolio P, in the capital asset pricing model. That is the market portfolio. Okay? So that's kind of cool how this all ties together. So that's what I mean by that. I forgot I put that slide in there. I wouldn't have talked about it. I would just show you that picture so you know exactly what we're talking about. And in the CAPM, we actually call this capital allocation line, we call it the capital market line. In the context of the CAPM, we replace that A with an N, and we call it the capital market line. Okay? 3, this is an important implication of the CAPM that I think is typically not talked about in the introductory class, but I think should be. This is a very important implication. Where does the risk premium on the market come from? The historical risk premium, well, historically equities, depending on the time period, how you measure, make between, say, 10 and 12%. Historically risk-free assets make somewhere around 4%. okay? So we've got this risk premium somewhere around 6, 7, 8%, depending on the time period. Why isn't that at that level? Why isn't it 3%? Why isn't it 15%? Why do equities historically average that much more than risk-free assets? Well, the capital asset pricing model tells us that the risk premium on the market depends upon the average level of risk aversion of a typical investor and the variance of the market portfolio. Okay? So this is how the level of risk aversion of the representative investor, which is actually a technical economics term, which you can think of as the average investor, how the risk aversion of the average investor actually determines the risk premium. Now, here's something puzzling that puzzles financial economists to the point where it's actually called an anomaly, an anomalous result. If you go ahead and estimate the average level of risk aversion using experiments, I could walk in here with $10,000, a bucket of cash, and I could ask you to decide which risky gambles you would accept. So there's a lot of money at stake, and you had to make real decisions. I could estimate your level of risk aversion. If I looked at the way you bought insurance, I could estimate your level of risk aversion. Okay? If I look at the sorts of things you invested, I could estimate your level of risk aversion. Well, if we come up with estimates of risk aversion based on those sorts of exercises, we would actually end up with a risk premium that's much, much smaller than it actually is, historically. Okay? In fact, people would have to be exceedingly risk averse to end up with the risk premium that we've observed in the U.S. over the last 50, 75 years. Okay? They'd be so risk averse, they wouldn't come to class because they'd be afraid of getting into a car accident. Okay, that's how risk averse people would have to be. So this is actually called the risk premium puzzle. Okay? Now, what are some explanations to why that might be the case? Well, part of the explanation may lie in the material that I showed you on the performance of equity markets around the world. It may be the case that the U.S. is central to money. Okay? Remember, top performing stock market in the 20th century was what country? In real terms. It was Sweden, right? Okay? And the U.S. was like fourth. But the U.S. was up there. It was really up there, really high. And the countries that were much, much lower, the countries like Japan, Germany, countries that historically had very good economies, but they were essentially destroyed in the Second World War. So this could be in part simply due to the fact that the U.S. has had an anomalous result because we've had good luck. We haven't been involved in these sorts of we haven't been affected to the extent that other countries have. And investors knew that that was a possibility. Okay? But then finally, the last implication of the cap-out is the risk premium on individual assets will be proportional to the risk premium on the market portfolio, and that coefficient of proportionality will be beta, where beta is the covariance of the return on the stock in the market divided by the variance of the market. And the expected return of a security minus the risk-free rate, or the risk premium on an individual security will depend upon its beta times the risk premium on the market. Okay? And this is exactly what we learned how to estimate yesterday. We estimated yesterday for Newmont Mining. Okay? That article that I started to read in the Wall Street Journal, by the way, I was talking about the risk-on, risk-off trade and how stocks have tended to move together or not move together, actually talked about stocks that have been most in sync with the S&P 500 and stocks that have been least in sync and in many cases inversely correlated or negatively correlated with the S&P 500. And one of the companies in mentions for not having been seen is actually Newmont Mining, which is the company that we actually estimated the beta for yesterday, and we got a beta that was insignificant. Okay, I told you that was an anomalous result. We wouldn't expect to see that typically. Okay. Now, all investors hold the market portfolio. Why is that the case? Given the assumptions of the model, it's not surprising, okay? Because there's symmetric information. Everyone only cares about expected return and standard deviation, okay? So it's not surprising that all assets will be included in the market portfolio, okay? The contribution of the capital asset pricing model is to find the fair price that will make all assets be held. That's what the capital asset pricing model is. How do you find the fair price? And the capital asset pricing model says, gee, the risk of an individual security is going to depend upon its contribution to risk of the market portfolio, so therefore its expected return must exactly compensate people for that level of risk. Okay? So the CAPM is built on the insight that the appropriate risk premium is determined by its contribution to the risk of the investor's overall portfolios. Now this is why you have to understand how to calculate the variance of a portfolio to not only do the sort of analysis you're doing in the project, but to understand the intuition behind the CAPM. Let's assume that there are 5,000 publicly traded securities in the U.S. And let's take a company like General Motors. What is General Motors' contribution to portfolio risk? Well, you know how to make that calculation now, right? We create this matrix, and the matrix would have the weights on all the assets in the top row, the weights on all the assets in the left column, okay? And each element of this matrix would be the covariance between the weight in the column and the weight in the row. So if we have 5,000 assets, we would have 5,000 squared elements in this matrix, okay? But what is GM's contribution to the risk of the portfolio? Well, it's going to show up 5,000 times in this row. It's going to show up 5,000 times in this column, okay? There's one variance term here, the covariance of GM with itself, okay? So there are 4,999 times 2 covariance terms. One variance term. Obviously, GM's contribution to portfolio risk depends upon its average level of covariance with the market portfolio, okay? So you understand why covariance is what matters, why that's what characterizes the risk of GM. Okay? So we can derive the GM's contribution to variance to be the weight on GM times the covariance of the return on GM and the return on the market. Okay? So now that we know the contribution of GM to market variance, what's the appropriate risk premium for GM? Well, it's risk and return. This is how we define risk. We've got to get a return, an expected return on GM, which just compensates people for taking on this level of risk. Okay? It can't be too much expected return, because if it's too much expected return, people will rush in and buy GM, push up the price, and reduce the expected return. It can't be too little expected return for this level of risk, because if it's too little, people will sell GM. Make the price go down until the expected return goes up by enough to just compensate people for that level of risk. Okay? Now this is where the stars start. Okay? And I go ahead and I derive what the risk premium has to be. And again, this is the page where the eyes would usually start glass forward. I told you the story about my friend from Miami that wanted me to manage her portfolio, right? It was all rolling over in T-bills. And I drove her out across the Everglades, and that's where I thought I'd talk about risk and return. Remember that? And I told you how our eyes glazed over. That's what I mean. It's that same look. It brings back all these negative things. Okay, so here is where we're getting close, we're getting close, we're getting close, and then we end up by deriving the CAPM pricing relationship. But the intuition here is really straightforward without doing all the math. The intuition is simply that we need a risk premium on an individual security that compensates for the level of risk in a security, and the key is to understand how we define the level of risk. The level of risk depends upon the level of covariance of the stock with the market portfolio. So we end up with this risk premium is equal to this covariance over the variance of the market times the risk premium in the market, and this is the CAPM relationship. This is the expected return beta relationship. This is the reward risk equation that we derived and used yesterday in calculating the beta for new money mining. Okay? And again, that's exactly what you saw when you took the intro. Now, we can portray the expected return relationship with a security market line. Now, I want you to know, this is a very different picture than the picture that we've been looking at. This is not a capital allocation line. Okay? This is the security market line. Very, very different picture. Why? The capital allocation line shows us the expected return relative to the standard deviation of the portfolio. This shows us the expected return as a function of the beta of the individual asset. The standard deviation doesn't matter when we're talking about an individual asset. That's one of the counterintuitive but very important results of the capital asset pricing model. Own risk doesn't matter. The variance of GM doesn't matter. What matters is the covariance of GM and the market. That gets translated into beta. So the risk premium on the individual stock depends upon the beta of the individual security. Okay? Question. If a security has a beta of 0, what would you expect for its expected return?
0.
No? Beta 0. What's the expected return? Risk-free rate. Risk-free rate. Okay? If the beta of a security is 1, what is the expected return? The market. Okay? Question, true or false? I've asked this question on exams before. I might even write this question down, because who knows? I might ask this question again by mistake. Even though I just told you the question and gave you the answer. It's known to happen. It's known not to happen too, so don't be disappointed if you don't see it. If an asset has a beta of 1, it has the same standard deviation as the market. Why?
Beta measures the return on the actual stock on the asset and same deviation of the market.
Keep on the right track, but someone else. If an asset has a beta of 1, it has the same standard deviation as the standard deviation of the market portfolio. Absolutely false. Okay? The beta of 1 means that the slope of the regression line that we derived yesterday is 1. Okay? But that doesn't mean that doesn't say anything about the standard deviation of that. That could be a very, very risky stock. It could be loads of firm-specific risk. What it means is that the systematic risk of that asset is 1. Okay? Because the beta doesn't care about standard deviation. The beta doesn't incorporate standard deviation. Doesn't incorporate standard deviation. So this is a really important relationship. The security market line, it gives us a way to characterize the expected return on a security as a function of that security's beta. Okay? Now, how is the kappa used? Widely used in finance. Okay? Many firms rate the performance of portfolio managers according to the reward to variability ratios they maintain and the average rates of return they realize relative to the security market line. Okay? Now, this is an important result. The beta of a portfolio is simply the weighted average of the betas of the components. So if I were to ask you on the group project, you calculate the beta for 3 companies. I think there were Google, Apple, and what was the third? Chevron. Okay? If I ask you to calculate the beta for those 3 companies, and then if I were to ask you, what's the beta of an equally weighted portfolio of the 3 companies, what would it be? It'd be simply 1/3. You don't have to do any more spreadsheet work. You just get out your calculator. We'll do this in the spreadsheet. It'd be 1/3 times the beta of Chevron plus 1/3 times the beta of Apple plus 1/3 times the beta of Google. The beta of a portfolio is the weighted average of the beta of the portfolios that go in an example. The beta of the portfolio is simply a weighted average of the betas of the components of the portfolio. Okay? Did I ask you that question on the project? To calculate the beta of the portfolio of the 3? I didn't. Yeah, I forgot to. So I'll probably have to ask you that on the exam. Okay. A portfolio or asset with a higher realized return relative to the market than that predicted by its beta has a positive alpha, denoted by an alpha. And this gives us a way to evaluate the performance of hedge funds. Okay? Here's the idea. The beta of a stock, or the beta of a portfolio, tells us the fair level of expected return given its level of systematic risk, its level of beta. Okay? And here's an example where the risk-free rate is 6%. The market portfolio has a return of an expected return of 14%, and the beta of the market portfolio is 1. Now, what this picture tells us is that if you simply tell me what the return of a fund has been, that's not enough to pass judgment on whether or not the fund manager did a good job or not. Okay? For example, I told you about my cardiologist friend who was buying all these internet stocks during the late 1990s, reading all these newsletters, and he was always bragging about how well his portfolio was doing. And I would say, Mark, what's your risk-adjusted return? I said, what do you mean risk-adjusted return? I don't care about my risk-adjusted return. I said, you don't care about how much risk you're taking on to get that return? Well, I just care about the money. Okay? Well, finance says it doesn't make any sense to talk about return without talking about risk, right? It turns out he was taking on a lot of risk, and it also turns out that it's really easy to confuse stock picking genius with a strong bull market. And when the market turns down, people that look like geniuses look like idiots really fast. Okay? They're taking on a lot of risk. Now, what this picture shows here is that you could beat the market by a substantial margin and be out here and have a underperforming portfolio. Because you're not getting the level of expected return that you should, the amount of risk that you're taking on. And you could have a portfolio down here that's underperforming the market in terms of expected return, but actually is doing a very good job because you're getting more expected return than would be expected for the level of risk that you're taking on. Okay? This is what a lot of hedge funds aspire to in this region here, to have a lower level of risk than the market portfolio and have a lower level of return, but to have positive alpha. Alpha is the difference between the actual point in expected return beta space and that which would be predicted by the security market line. So this is an example of positive alpha, okay? And if a portfolio were here, even though it's above the market, it'd be an example of negative alpha, because this distance would be negative. Does that make sense? Yeah.
So when they talk about the hedge funds are trailing indices, and they're talking about the return, it's really an insignificant figure because the strength of the hedge fund is there.
Well, what I would say is you don't have enough information to judge. And that's what I would not expect this kind of writing in the Wall Street Journal. This guy should have said something about risk-adjusted performance. He said that they underperformed, hedge funds underperformed, or actually it was Henry Blodgett that said that. Okay, Henry Blodgett said hedge funds underperformed the S&P 500, but he didn't talk about risk. And in fact, many hedge funds have been substantially less risky than the S&P 500, depending upon the strategy. There are many different types of hedge funds. Remember, all it means to be a hedge fund is that you're unregulated and you can do whatever the hell you want. Okay? But you would hope that the hedge fund manager would have a clear strategy that he or she would communicate to clients. And some hedge fund managers say explicitly, our goal is to have a bond-like return that's substantially less risk. Some would say that we want to have an S&P 500-like return with less risk. Some would say we're just going to try to hit home runs, okay? And we're going to take all our money and put it on Red 32 and take a lot of risk. Okay? Some hedge funds do that. So to lump them all together can be somewhat misleading. Yeah.
Can you again explain the beta again? What is it telling us? And
What?
the beta? The beta? I'm sorry,
Okay.
beta. Beta. My bad.
The beta tells us, okay, there's the formula for beta, which you can think of almost as a correlation, okay, between the stock's return and the market's return.
Yes.
And in this context here, since the covariance of an asset with the portfolio determines its level of risk, the beta tells us how much return we should expect for the level of risk that we've taken on. And beta is what characterizes the level of risk.
Mm-hmm.
This is the level of systematic risk. Beta is the measure of systematic risk. Beta is the measure of risk in a well-diversified portfolio.
So are you saying the higher the beta, the more expected return?
The more expected return you should receive.
But higher, it has nothing to do with risk then, right? Higher than
Yes,
you're taking
the
higher
the
risk.
beta,
I see.
the riskier the portfolio,
I see.
therefore the more expected return you
I
should
see.
receive.
I see. I see.
Okay?
Okay.
So this is a really important concept. In fact, there's a website that's popular called Seeking Alpha. If you read or listen to portfolio managers talking about what they're doing, sometimes they'll say something like, yeah, we're looking for alpha here. We're looking for alpha there. Okay? We're trying to find alpha. What are they talking about? They're trying to find alpha. They're trying to find a return above and beyond a return that's due to firm-specific factors. Alpha is due to firm-specific factors. So if you're trying to find companies that have new technologies that are going to break through, that are going to crush the market, you're looking for alpha. Okay? That's just part of the jargon. Seeking alpha. Okay? Many firms use the security market line to obtain a benchmark hurdle rate for capital budgeting decisions. We talked last time about how that can be actually kind of silly, because you can't estimate beta with any precision. Okay? Much less the beta of projects. Because most companies are going to be concerned about the right cost of capital for a new project. How do you estimate the beta for a project that has yet to be initiated? Theoretically, it's a beautiful concept, but putting this in practice is problematic at best. Okay? Regulatory commissions use the expected return beta relationship along with forecasts of the market index return as one factor in determining the cost of capital raised in firms. And what are some of the implications of the CAPM? The passive strategy is efficient. Yeah, well, we assume symmetric information. We assume symmetric information, of course the passive strategy is going to be efficient. So I'm not sure I would take that as a real important contribution to the CAPM. Okay? The CAPM implies the market portfolio is the optimal risky portfolio. We already know that indexing is a low-cost way to invest in equities. The CAPM implies it's also the optimal way. Okay? The CAPM provided the intellectual justification for the rise of companies like Vanguard and the proliferation of index funds. In fact, John Bogle, when he started Vanguard, when he came out with the S&P 500 index fund in the 1970s, he was almost laughed off Wall Street. Oh, yeah, I can have an index fund, and people are going to be interested in that, and you think you're going to be able to beat the market. But you think about it, what is the market composed of? Let's assume there are no index funds. They're just professional money managers trying to beat the market. They can't all beat them. They can't all be above average, right? It's impossible for them all to be above average. And if they're spending a lot of money trying to compete each other, and then you can come along and free ride off their efforts by simply buying the market portfolio, I think your chances of beating the market are really good. Okay? Okay, is the capital asset pricing market, is the CAPM valid? The capital asset pricing model valid? Very important topic. In fact, it's so deep and so important, I think you should all go take a break and prepare yourself for it.